Welcome to Subramani. I'm going to talk about investing in debt markets, because a friend of mine who's a significant investor in debt, apart from equity, of course, he wanted to know what are the options which are available. So let us split the debt investor into 2-3 categories. First category is a retired person who wants to put money in debt and who has zero tolerance for default. Or even delay. Forget default. Like what happened in Franklin Templeton was not default, it was delay. So you got your money after maybe a year or two, and that's not a very great thing. You got it in tranches. You had to pay short-term capital gain. If you're a recent investor, you had to pay long-term capital gain. I would have invested in a ultra short bond fund, saying I will withdraw this only at the end of my life. Or somebody else will withdraw it. So it never bothered me. But all this money came back, and now again you have to look for options of where to invest. So first is the category who can't take any risk, either or with liquidity or with the duration risk, or with the who can't take any risk with the liquidity, in the sense they will need the money on the date that it is due, or they should have full liquidity. Right, very many people are worried about full liquidity. So when I'm talking to you, will understand why I am not so much in favor of full liquidity for full portfolio. It does not make any sense. The second category is that 40-year-old, 55-year-old trying to build his portfolio for his retirement, and he can look at maybe go to PSU bonds and maybe some private sector also, but more like looking at the short-term bond fund or a slightly longer-term bond fund, maybe 3-4 years kind of maturity, not worrying too much about the impending interest rate hikes, because if the interest rate hike does not happen quickly, then you're losing out opportunities. So some of those things. Now I'm coming to the more interesting category, the third category of people who want a slightly higher return than what they are getting in the current scenario. Right, in the current scenario you're not getting great returns from debt, and that is fairly obvious. That is because the government is pumping so much money into the economy. Now lies your opportunity, that if you are willing to compromise on liquidity, if you are willing to compromise on the level of risk that you want to take, and therefore get a higher return, there is a possibility for you. Now this is the separate category, HNI, debt investor, who is looking for some alpha even in debt. Personally, if you ask me, I would look for all my alpha in equity. Why would I look for alpha in debt? But then there are some fun-loving people who like to seek some risk. So there can be private credit. So private credit is somebody to whom credit is not so easily accessible. Either you could do it yourself because somebody approaches you, some builder comes and tells you, I want some 20 flats to be funded, will you do it for me, or things like that. Or some lower end lending, which means you are willing to lend at the bottom of the pyramid through somebody. That you cannot do it on your own because you don't have the expertise. But there are people who have expertise, so typically they're called money lenders, but I'm not talking about them, but I'm talking of slightly less risky than the money lending directly. So you go and lend money to a money lender. There are opportunities like this available at the bottom of the pyramid, and those returns are high. Those returns don't hit you in the market, because it's really got nothing to do with the market returns, right? So, but well, it does happen that you have opportunity there. Then there are special situations. Somebody who is currently in trouble, wanting to come out, not wanting to dilute equities too much. You can ask for the best way I have seen deals like this happen is, one, you quote a higher rate. So currently we are in April 2022. So let's say you ask for 12% return. There is no way in hell you can get 12% return. Now what is the risk? Risk is you will lose your principal. What should be the sweetener that the client is giving you? If he's a listed company, he should be giving you zero coupon bonds, or rather he should be giving you options on the equity, right? So he should give you options saying, if I don't repay, you have this option which you can exercise and buy my share, and that should be at 40% discount. So these kind of deals happen, but they don't come out in the open so often, right? So this you can protect yourself. So private equity is then special situations, and third is the real estate, because real estate, all the liquidity in the market, whichever the government is giving, whatever the government is giving, is not reaching the real estate market so easily. So go to a builder who is sitting on a lot of illiquid flats and offer him money on interest, and amazingly attractive deals can get done there, right? So this is like a credit risk that you're taking. You're also taking another risk called you're being paid an illiquidity premium, because suddenly if that broker were to die or to default and you have not done too much of a due diligence, most of us can't do that detailed due diligence which an institution can do, must do. So in those cases you will obviously get a premium, what we call the illiquidity premium, and you may suffer it also, because you may not get your money in 3 years, you may get your money in 7 years, but for those 7 years you will be getting the interest. So right, so structured deals which are more long-ended, maybe 20 years, out of which first 5-7 years he pays only interest, after that he starts paying interest and some part of the principal, and EMI gets built into it, and it takes 20 years for the process to be completed. So if you're 55 years, 60 years of age, let's say 57 years of age, and you know that you want income only after the age of 65, this is a good deal to do. So first 5 years it's cumulative interest, he does not pay you anything, but after that he starts paying you at say 12%. That will be effectively saying, okay, these 5 years interest has doubled, so I'm actually paying only 6%. So this is one more way of structuring it. But make sure that you put all the conditions, all the locks, all the caps, all that perfectly in place, so that tomorrow if something were to happen to the builder or to his key man who is there, on whose trust or on whose personal guarantee you have lent money, if that person is not there, then what happens? So you have to build all that into it, and therefore you can justify maybe a 15% interest or a 16% interest, because your first reaction is, why is he paying me 16% when he can get 11% in the bank? Simply because he cannot get, right? He's perhaps over leveraged, he's over borrowed something. So take into account all that, take into account whether you want to take so much of risk. Based on that, you can do this kind of debt investments. Personally, if you ask me, I'm not too game, but I have put some money in credit risk fund. But other than that, I don't put into these schemes, but these are beautiful schemes which I have seen people put. So I'm not marketing it, I'm not doing anything, I have no vested interest. Right now, I don't even know whether many such deals are available, but these kind of things will work for somebody who is putting in say 5-6 crores in debt and wants to create some variety there apart from just an ultra short bond fund or a liquid fund. Thank you.